And we are halfway through the course. I hope you've been able to implement the learnings and not just gone through the course as a reading material or a resource, but actually put these things into practice. We've already started receiving a few queries from you, a few doubts, and we're glad that we're able to help you out with all of those things. At the halfway mark today, we are going to cover a very important topic, something that a lot of your investors will ask from you. This is a little tough in terms of the topic, financial modeling. Again, I've spent years perfecting this art, so it's going to be tough for me to explain it to you in a way that you're going to get a hold of it in just one lesson. So we do have another course dedicated only to financial modeling. If you understand the basics today, you can go into an advanced level course from here into the details of financial modeling. Otherwise, we've also created a few shortcuts for you. By the end of this class, we'll share a few templates with you that you can plug and play. In fact, there are a lot of AI tools also today wherein you can enter your details and that'll create a financial model. If you have some kind of a background in accounting, in finance, it's not very tough to create a financial model for yourself. But if you have no background in any kind of financial basics or things like that, here are two suggestions. One, you could use the templates that we provide. Try inputting the numbers and it'll create the financial model for you. Two, you can go to the softwares and AI tools to create your financial model. Or finally, you could consult a CA or reach out to us and we'll be happy to connect you to someone who does financial modeling for startups on a professional payment or fees. Right? So let's dive into the curriculum for today's module. We're going to understand what financial modeling is as a general concept, why it's important. Then we're going to also understand a key difference between valuation and pricing. We'll understand what actually drives value and then move on to a few methods in which early stage startups calculate their valuation. Finally, we'll end up with a few key terms, key ratios that should be on your fingertips in case you are looking to raise investments, because these are all very important terminology that anyone who's probably looking to invest in your startups is going to ask you. Without further ado, let's start with financial modeling. Financial modeling is basically converting your business narratives, whatever you've been talking about, thinking up until now, in terms of how your idea will actually become a real business, revenue making. How do you put that into a spreadsheet, into a Google Drive, into a Google spreadsheet, or an Excel file, and you try to understand what is moving in your business, whether your business will end up making money or whether it will lose money, for how long will it lose money before it breaks even and achieves profitability. So basically, the idea of every business has to make money. And initially, a lot of businesses do invest money. Some of them take off directly without burning money. And your financial model gives you an overview of all of those things. I've repeated this statement quite often. As founders, you cannot shy away from two things. One is sales and the other is finances. You need to understand these two basics despite the background that you come from, because these are the real things that drive your business. Everything else, over a period of time, you can start outsourcing, you can hire professional people, but these are two things that you really need to keep a grip on. Talking to your customers, understanding how the market is evolving, and also understanding your finances. These are two things that you can't outsource, even though you have professionals doing it, but you still need to have a very strong grip on these two aspects of your business. A financial model is also required by your investors, but I feel that a financial model is not just a tool that you present to your investors with inflated valuations and inflated numbers. They're going to catch it if you inflate your numbers, but this is something that proves the rationale behind you actually investing that kind of time, money, effort, whatever you may call, into your business. If it does not make sense on an Excel sheet, it will probably not make sense in real life also. And also, a financial model is not just something that you create at the start of your business plan. This is a live document that you should be updating probably every 2 weeks, or if not that, at least monthly, in order to ensure that whatever you had estimated, how far you are from that in terms of estimation, whether you're overachieving, underachieving, whatever the case may be, but you should be updating your financial model, not just from an investor's perspective, but also to keep yourself accountable. As founders, we really don't have someone that we report to. So this becomes a reporting mechanism, something that you adhere to in terms of keeping up with the plans that you have for your business. And if you're not meeting your goals on a consistent basis, then you might want to revisit your goals or think of different strategies to achieve those goals. Now, I have honestly learned financial modeling during my MBA days, during my college days, through a lot of those activities. But I've also learned financial modeling from one of the best professors for something like this. His name is Ashwath Damodaran. You can go out. He's a professor at Stanford University, and every year he publishes his courses for free on YouTube. I have derived a lot of my learnings for this class from his courses. I'm going to make it easier for you to understand, but what he covers in probably 15-20 hours, we're going to cover in a short duration. So a lot is going to get missed over here. If you want a detailed understanding into corporate finance and valuations, I highly suggest you to go over his courses as well. We'll link his courses in the description to this module, so you have easy access to those as well. So for anyone who wants to dive deeper, you have the option of going for his free courses or joining one of our courses where we discuss financial modeling in much more detail for early stage startups. So again, coming to the concept of valuation and pricing. Valuation is intrinsic to what your business is going to be doing. It's intrinsic to your business activities. It's focused on what your business, in terms of the revenue, in terms of the cash flow that it's going to generate over a period of its lifetime. Versus pricing. Pricing is what the market is willing to pay for it. If you go back to Economics 101, pricing is a function of demand and supply. It is determined by demand and supply, which is why a lot of times when, let's say, even IPOs, when they come out, the valuation that the experts come up with is very different from the price that the market is putting onto the IPO, right? The pricing could be much lower, the valuation could be much lower in some cases than the pricing because of the demand and supply at play. And the same thing actually happens with startups. If you are able to showcase a lot of value in terms of storytelling and how you position your startup in front of investors, which we're going to cover in the later modules, how you pitch and how you position. But if you are able to pitch in a way that you are able to establish a lot of credibility, let's say you have some kind of an unfair advantage that most people don't have in your industry, or there is some moat that you're able to establish early, that shows defensibility in your business that will actually increase the demand for people who are willing to invest in your business. And once you are at that great space where there are multiple people willing to invest in your business, that is when the game of pricing comes in, where there is more demand than the supply. Obviously, you can't take everyone's money, and that's a happy problem to have, obviously. So in that case, you can obviously value your company much more. In fact, you can price it higher than its intrinsic value. In terms of valuation, a value of a company is the amount of cash that it will generate over its lifetime. That's the value. The net cash from investments, from your revenue. So you subtract the revenue from the investments, the money burnt, and finally the net cash flow that you get over the course of the lifetime is actually the value of a business. I'm not going into detail in terms of how you derive that value, because we're going to be covering that in the later sections of this module. But basically, to give you a brief, it is the value that you generate from a business, the cash that you generate from a business over the course of its lifetime. Now, there are 6 main drivers of value, and we're going to cover all of them in detail, or let's say a basic understanding of all of them before we move into the models and how we use that to create valuations, Excel sheets, and etc. So the idea again for this module is to give you a brief so that you understand all of those things. Now, whether you're able to actually implement that into your financial model or not is based on your capabilities. If not, again, there are multiple resources that you can use to streamline that and to help you create your financial model. In fact, once you do create your financial model, do share it with us, and our team would be happy to give you feedback if we feel that there are some things off with it. And again, this is a part of the process for you, so we understand it's going to be a learning curve, and we're again very happy to give you feedback on that. So let's understand the value drivers of a company. First is revenue growth. How much revenue is the company going to grow at on a year-on-year basis? It's not just the first year or the first quarter of the business that we're talking, but once we talk about the lifetime of a business, you need to understand that initially maybe there is this rocket curve that you grow at, but over a period of time that's going to decline, that's going to plateau and ultimately decline. That's the business cycle of every business. So you have to understand what is a good fair number at which your revenue is going to grow. And you can change this number. Let's say in the initial stages, it could be a higher number, but as your number grows, growing it again at 100x or 200x number would be very tough. So you need to understand whether it's going to grow 10%, 20%, 30% based on the market realities, but be fair in terms of these numbers. The numbers that you assign, you should be able to justify those numbers. It's not just creating a financial model that comes up with $1 billion valuation. It's also the inputs that you're using, such as revenue growth, and you should be able to justify why you've used that number. Maybe it's something related to your industries, market has changed, or you've seen competition, or there's something in the industry that proves a benchmark, or you have some historical data that you can build your model on top of. Second value driver is operating margin. What is your gross margin? What is your net margin? Gross margin is basically your revenue minus your cost of goods sold, gives you a basic gross margin. Then you subtract all the other expenses and come up with a net profit. So you want to understand what is your operating margin. The third is the growth or investment efficiency, meaning how are you investing the money that your company is generating into future growth? What are the assets that you're buying? What are the new product lines that you're starting? Where is that cash flow going? And how efficient is your revenue making from that extra cash flow that your company is going to start generating, right? So these 3 drivers give us the basic expected cash flow of your company. Revenue into operating margin minus taxes minus reinvestment. That is your free cash flow of your company. Now, once you have that, we discount the cash flow that you're getting in the future, right? You understand the concept of time value of money. 100 rupees today is not the same as 100 rupees a year from now. Why? Because you have a opportunity cost, a basic opportunity cost to make you understand. Let's say even if you put your money into a bank, the 100 rupees a year from now, it's going to be, let's say if it's invested at 6%, it's going to be 106 rupees. So the cost of money deteriorates. There's a cost of capital. The money value increases in the bank. So any amount of money, let's say that you generate in the future, you have to discount it today. How do you discount it? You come up with a discount rate, which is a function of cost of equity and cost of debt. These are 2 very basic instruments. It varies. Again, This is again something that you need to dive very deep into corporate finance to understand the different drivers of these two costs. But for now, I want you to understand that equity has a different cost. Let's say you invest the money in stock market, it gives you a different return versus you invest it in a debt instrument. The return is going to be probably lesser, again less risky, more risky. All of those things come into play. The market that you're in, the economy, country risk, a lot of things come into this while you're determining your cost of equity and cost of debt. But these two together make you come up with a discount rate. And finally, there is a risk. Every business has a risk of failure. Maybe it's market, maybe it is the industry that you're operating in, or let's say there are macroeconomic risks, and we are going to cover a few risks in the next sections. But these are the 6 main drivers that make you come to a valuation of the business. So first is your free cash flow that you come up with from revenue growth, operating margin, and growth or efficiency of your reinvestments. That gives you the free cash flow. Once you have the free cash flow, then you discount that on the basis of cost of equity, cost of debt, and you also take into account the risks that your business operates in. Now, the major problem with valuing a company at an early stage is the fact that since valuation is derived from the amount of money that the company is going to generate over its lifetime, you really don't have any kind of historical data to judge the operations, the market, or the potential opportunity size, right? So that becomes very tough to determine the value of a company in the beginning. There is actually no data, and all the value that you are probably putting onto your business is an estimate. This is really the problem of putting any kind of valuation at an early stage, which is why we have instruments like a SAFE or a convertible note that a lot of early stage companies use as a way of as an instrument to raise money. We're going to cover this in our fundraising class, the instruments that are used, and we're going to cover these instruments in detail. But this is the reason why these instruments are used, because any kind of valuation activity requires a lot of historical data, which is why, let's say, mature companies which are already listed on the market have some kind of value drivers. There is some performance proof. There is historical data on top of which these financial models are built. But for young companies, the problem is that all of these are estimates, and how good you are able to estimate it, how well you are able to defend your estimations is usually the tug of war between investors and entrepreneurs at an early stage, right? So coming from that, there are 4 main things that derive the value of your company. The value added, or let's say destroyed, by growth assets. Not all of your investments are going to work. So you need to understand what investments will work, what are the investments that will grow your company. There are going to be some investments, again, if you know it in advance that these investments are going to burn money for you over the course of the company's lifetime, then you will probably not make it. But as business owners, we really don't know before we experiment. So there are going to be some investments that will not work out. The second thing is the cash flow from existing assets. Yes, you're going to grow, you're going to grow your operational lines, you're going to experiment with new verticals. But if there are some established verticals, what are the cash flows that are coming from them? Then you want to understand what is the riskiness of the cash flows, right? From existing as well as the growth investments that you're going to plan. From existing investments, there could be risk in terms of maybe the market changes. Maybe there's a war that changes the entire macroeconomic condition for your business. So there are a lot of risks that come into the business. This again plays a part to determine the business risk. And then there's obviously the point in terms of when your company is going to grow and mature to a level that you can have some kind of wherein you can estimate in terms of some kind of trajectory or some kind of stable growth that your company is going to have, or if there are some potential roadblocks into your business, how soon those roadblocks can be removed. Maybe it's something that deals with economies of scale. For your business to make a lot of money, it needs to reach a scale where you break even very easily. Even by selling certain amount of goods, you're able to break even on your fixed costs. So some businesses require that kind of a scale to achieve profitability. So these roadblocks need to be removed, and you need to understand when those roadblocks will eventually be moving. All these factors together, again, are a part of your financial model. Before we go into valuations, financial model, and what all is there, I also want to discuss risks. What are the different types of risks that come into any kind of business, right? So there are three major categories if I were to divide them. The first being estimation versus economic risk, right? You could use a wrong model, or you could use the wrong inputs. Your estimates could be wrong. The assumptions that you're making could be wrong. So that is a big risk. Again, at an early stage, the risk kind of increases because there are more assumptions than at a later stage. For a seed stage company, the estimation risks will be much lower than, let's say, a Series D or a late stage PE kind of a funding company, because they have a lot of data that they can use to base their future assumptions on. Right now, you probably don't have as much data. The second could be economic risks, right? The market for your product could change. Today with AI, things are changing so fast that a lot of companies are going obsolete. Their products or services are not needed anymore. The market is changing very fast. So any kind of investment in AI companies today has a lot of risk, because again, we don't really know. Even with one model, one incremental change in the existing AI models, things are changing so fast. And I assume that this change is going to only accelerate in the future. So if you are building in any kind of an industry which is changing very fast, then please be aware that the risk of your business is much higher than a traditional business already. So again, investors will use this against your in negotiation with you, because the risk at this stage for any kind of AI startups is a lot more, just because the market is changing very fast. Then the second category is micro versus macro. Micro meaning things which are for your company, for your industry, in a very small, let's say, viewpoint, right? The market for your product could change, or the competition could react in a way that they either cut down the prices or come up with a more efficient product, and your users might shift to competition. So anything that deals directly with your company, the industry immediately around that. So those are micro risks. Again, when someone asks you about risks, don't be blank. You can use these templates and come up with risks for your business. If you are more aware of the risks of your business, you actually sound smarter than people who say that my business has no risk. The other part could be a macro risk, right? Again, as I said, there could be a war-like situation, or there could be a drought, there could be a flood, things that could change the global shape of the economy. That could be something that comes in as a risk. As the company grows, your risk profile changes from a more micro to a more macro kind of a scale. Again, we're going to understand a little more on this later, but at an early stage of your company, it is more about your product and the immediate competition. As your company grows, goes global, expands globally, goes into more markets, the risks shift from micro risks to more macro risks, which are dependent on larger factors which are beyond your control. Then there could be some risks which are discrete versus some which are continuous, right? Discrete risks mean that risks that are essentially there, hiding, and they could come up at any point of time. Let's say some regulation, some law changes. These are risks that are there for your company, but they're not immediate. They could come up at any different point of time. And then there are continuous risks. Things like changes in interest rates or economic growth. The country's economic growth slows down. The federal bank changes the interest rate. If you see why a lot of financial analysts, markets immediately react to any kind of rate cuts by the US Fed or the RBI or any other country's central bank changing the interest rates. So all of those things also have an impact because it changes the borrowing cost for the company, it changes the cost of capital, the rate at which your cash flows are being discounted. All of those things also change your business valuations. So these are three main categories. Again, there are more risks that a business has, but if you look at it, they fall under these three subcategories. If you look at risks from, again, as I said, from a life cycle of a company at an early stage, it is a very micro risk related to your product, your industry, and as you grow and you go global and you expand, they become more macro risks. At the initial stage, there is a risk of the idea itself, right? The idea might or might not work. Then once you bring out your idea, create your product, put it into the market, then there is the business model risk, whether you're pricing it in the right way, whether the business model that you've selected in itself is a risky business model, a subscription-based business model versus a one-time fee, whatever it may be. So there are risks based on the business model. As your company grows, then there is a profitability risk. You've invested a lot of money, whether your company will actually achieve profitability or not. Without taking any names, there are some companies that have gone IPO and post that they've had this profitability risk, which is again why a lot of investors today are scared of investing. A lot of investors have pulled back on the investments that they were doing in startups. The reason has been because a lot of IPOs have failed. They failed because despite those companies achieving high scales of revenue with the investments, with the burn, they haven't turned profitable. A lot of companies haven't gone IPO because they haven't been able to achieve profitability. As you scale up, then you have the scaling up risks in terms of, let's say, your GTMS, right? We spoke about GTMS in the previous module. What has worked? India in itself is a very diverse country. What probably works in North India might not work in South India. So similarly, imagine going global. What works in one country might not work in a different country. So your marketing strategies, your positionings, everything need to adapt. So then when you're scaling up, there are those kind of risks that, yes, you've proven it in one market, but can you replicate that success in some other market? A lot of companies have not been able to do that. They've tried to expand globally, but their products, what works here in India, might not work abroad. So they've failed at that level. So those risks also come into play. Every company reaches a point where it plateaus, the growth plateaus. It does not grow at, let's say, what the growth numbers were initially. So then there are the growth challenges. How do you innovate further? How do you come up with new product lines? How do you get into new markets with the regulations? All those things impacting your scaling process. So that is a midlife crisis stage for a business, and eventually there is going to be a decline. So how soon are you able to realize that your company is now growing or going into a decline? Are you exiting it? Are you selling it as a merger and acquisition? Are you finding a strategic buyer, or are you completely pivoting your product or service? So all those things again come into play at a later stage of the company, right? So how your end game is also a risk. Again, as I said, you need to have different kinds of risk profiles based on the stage of your business, and the risk changes from a more micro level risk to a more macro level risk as your company grows. All right, now let's move on to valuations. And I feel valuation is not just in terms of the numbers that you have, but also in your storytelling. As I mentioned earlier, you go from your story. At early stages, obviously, you have potential, you have ideas, you have hope that what you are building, the market is going to take that. So you have a lot of estimations, which essentially means that you have a story. Anything that is not proven right now is hypothesis, is a story. How well you weave that story, how much it actually makes sense, is going to determine your numbers. So how do we go from a story to actual valuation, to actual numbers? First, you've got to develop a business narrative. By now, I feel that most of you have a business narrative. This is a product, this is a service, we validated with these kind of users, this is the feedback that we got, this is the product that we developed, these are the number of people that we're going to target, this is how we're going to target them, this is how much the cost of acquisition is going to look like, this is the pricing. You've decided all of those things up until now. So you already have a business narrative. Now you test that business narrative, whether it is possible, whether it's plausible, or whether it is probable, right? So possible in the sense whether it's actually possible or not. Plausible in the sense that it might seem true, but it might fall if once you actually hit the market with your idea. And in terms of probability, again, you want to understand what is the probability of success. The higher the probability, obviously, the better the weighted average. Next, you convert your narrative into the drivers of business, right? Going back to the drivers of business, what is going to be your revenue growth? What is going to be your operating margin? What is going to be your reinvestment strategy? The cost of debt, cost of equity, and the business risks. Once you've converted your narrative into these drivers, that's when you start building your financial model and get to a valuation. I'm going to tell you how we get to valuation through financial models. And again, you want to keep the feedback loop on. Again, as I said, at least once a month, revisit your financial model, what you create, and see what you'd estimated, how much of that are you hitting in terms of your targets, whether the numbers are going above your target, below your target, and then tweak your financial model based on that. At the early stages of a business, there's usually a tug of war. When you're trying to negotiate with investors, the tug of war essentially arises because founders are looking for a high valuation, they are looking to dilute less amount of their equity at an early stage, and most of their valuation is based on future numbers, versus investors who are looking to maximize the revenue, the equity that they take in the business. They are looking to lower valuations, obviously, because that's how they get a better upside in the future, and they try to base their valuations on the current revenue, on the current traction of the business, rather than future estimates. Usually, again, you'll see that there is a middle ground that you are able to come up with. Again, this middle ground could tend to be towards the founder or towards the investor. That depends on your negotiation skills. That depends on how much interest there is for your product or service. What is your unique advantage? What is your unfair advantage? What is the potential moat that you are trying to create for your business? The more moats, the more advantages that you have, the valuation tends to come towards your side of the narrative. And if you are someone who's just starting out and with a replicable business idea without any kind of advantage, then the investors might have a more say in the negotiations. And again, usually the people who are more desperate in the negotiations are the ones who are losing the negotiations. If you have something to lose by the negotiation falling off, then you are more likely to compromise. So when you are building your businesses, also think about this aspect. Now let's come to a few different types of valuation methods. I'm not saying that one is better than the other, but there are some which are used more, there are some which are used less. The first is a Burkus method, where this is a very simple valuation method. This will give you a ballpark valuation, not an exact valuation, but you can understand your value based on the valuation of companies which are similar to you, operating with similar products, services in similar markets, right? So in this method, you start off with, let's say, a valuation of a company which is operating in a similar environment, or a competitor to you. Just to give you an example, let's assume that company is valued at 1 CR today. You take 5 components. All these components are given equal weightage, 20% to each of these. So out of the 1 crore, 20% or 20 lakhs is given to each of these valuations. So you understand whether you have a basic business idea. That's your first component. So 20% as compared to your competition, where is your idea today? If it's at par, then you give the 20 lakhs. If it's better, then you increase the 20 to 25 or 30 or whatever. If you think it's 10 times better, then already you have at a 2 CR valuation just based on the idea. So the first component, you understand whether the first 20% is on the idea. The second is the management team, the founders, the early team members, founding team, or any experts, mentors for the team who are from the industry, who bring in industry expertise, who bring in connections that will help the company grow much faster. Or maybe you as a founder have been working in this industry for the last 5 years. You really understand what are the challenges that your users face. You have connections, you have suppliers of raw material, whatever the case might be. So you estimate how good your management team is as compared to your competitor that you took as a benchmark. So you again rate yourself on a scale of 1 to 10, or let's say on the 20% benchmark over here. Third is your prototype, the initial product that you've launched into the market. What is the technology risk behind that? Is that technology going to become obsolete very fast, or is that technology better than how your competitors are using it? Again, so that helps you determine this part of the business. Third is strategic tie-ups. Maybe even before you start your business, you have your tie-ups with manufacturers, with some kind of distribution networks already in place because of, again, your network or someone in your team or your advisors or your mentors network. So this is again determines the fourth component of your valuation. The final one is the production or the rollout risk, which is when you finally go into production, what are the challenges that you're going to face? Is it going to be as smooth as your competitor? Is it going to be as smooth, in fact, as you've planned? So what are the risks in that? So you give a weightage to all of these 5 criteria based on your benchmarking with your competitor, and then it could be 80%, the total could be 80%, it could be 100%, it could be 150%, and based on that you come up with a valuation. So for example, you gave yourself this total score that you got was 150%, and the initial valuation that you took as a benchmark was 1 crore. Your company's ballpark valuation, I'm not saying exact valuation, comes out to 1.5 CR. Or maybe your total score was 80%. So out of the 1 CR, your ballpark valuation comes out to be somewhere around 80 lakh rupees at this stage of your startup. The second method is a scorecard method. This is again very similar to the Berkus method. There are 2 main differences over here. One, we have 7 criteria instead of 5 criteria. And second difference being that instead of giving equal weightage, that is 20% to all of those criteria, we give a different weightage to the different criteria. There is a method to this, and I'll show it to you as an example. So there are the 7 criteria that we are going to be using over here are: 1, management team; 2, see, at an early stage, you will see that 30% is given to this criteria because at an early stage, it's usually the skill set or the network of the founders that are given more valuation. The products could pivot, the processes could pivot, the positioning could pivot. A lot of things are going to change from when you initially pitch to your investors to what your company actually becomes. But your founding team, the people behind it, are going to remain there. So this is why this criteria is given the maximum weightage. It's your skill set, whether you have that ability to actually make money in the same idea space or in different idea space, how willing you are to pivot, how you understand the market, what are the skill sets that are needed for the business that you bring in as a founder, basically. So management team is given 30%. Size of the opportunity is given 25%. Why is size of the opportunity important? Because if we're going to understand how investors make money and why they want bigger opportunity sizes for them to be making exits, but they really need a big exit for them to actually make money. And I'll explain this to you in the next module, where we talk about fundraising and where we talk about how fundraising works and what are investors looking for. But market opportunity, the market size, is again something that they are really very much interested in. So if you see these two criteria together comprise more than 50% of the valuation of your company. The next is again the product or the tech, which is given 15%. The environment, the strength, weakness of your competitors is given 10%. Again, as I said in the previous modules, you really need to understand what your competitors' strengths and weaknesses are. If you have no competitors, then it becomes a problem. The fifth part is the marketing or the sales strategy that you have, again given 10%. Then your need for reinvestment in the future. Usually when investors are coming in at an early stage, they take into account that you are going to raise more investments in the future. So this is not a very big problem. This is given about 5%. But let's say you need a lot of capital immediately after you raise your first round. You don't get too much runway out of that, and you're going to burn that very quickly. Then that increases your risk, because raising investments takes time. And you need to hit certain milestones as you want to keep raising more and more money. So the revenue, the growth rate has to keep growing. And again, finally, if you have some kind of feedback from your early adopters, that also reduces the risk at this stage. So that's given about 5%. So to give you an example, let's say we took a target company and we rate that target company on out of 100. We give it a score. So for example, in this case, we've given the management team out of 100, 150 for this particular industry. Let's say when I was starting Stitch Easy, my family had a 30-year-old garment manufacturing business. My CTO had built a tech platform before that. She was again a serial entrepreneur. Our third co-founder had supply chain experience. All three of us were very good friends. We'd done our MBA together. We were working together, all practically living together in the same city. So for that particular opportunity that we were going after, we were well qualified. We had the experience, we had the network, we had some kind of teams, alliances. So sales was easy, growth was easy, getting suppliers was easy, building the tech platform was easy. In that sense, because of the capabilities of our team, there was a lot of founder market fit, which is why we did get a lot of investment offers almost at an idea stage. And as we went towards our MVP and we pitched with our MVP, we did receive 2.5 CR of offers in terms of investments, which we later declined, but this was just on the basis of one presentation that we gave. Now, so let's say if I were to rate my company on that scale, we would have given us 150 on a scale of 100. Then the size of the opportunity on a scale of 100, we've given it 120. The product or tech, we did not have it, so given it 80. Competitive environment, yes, there were competitors and there were some who had 2-3 years of experience before we even started. So they had started penetrating the market, they had paying customers, they were growing consistently. So there was a competitive environment, but again, there was some white space that we were going after. There was a sustainability angle that none of them were going after. So in that case, we'd given 120. Marketing and sales, considering we did not really have any kind of traction then, so we'd given it a lower score, 50. Need for further reinvestments. Since it was a tech platform which would have grown like a SaaS business, the potential investments that we needed in the future were comparatively less, and we'd estimated that we would be able to grow profitably in the future. So the need for reinvestments, for external investments reduced, so given it a 50. and there was good feedback, so gave it on par as 100. Now, when you multiply the first two columns, you come up with a weighted average. The total of that weighted average is what gives you a score on a basis of 100. And in this case, considering the weighted average was 111.5, you give yourself a 1.115x multiple. So if a competitor is valued at, let's say, 1 million, your valuation in this case is going to be 1.1115 million. The third method is the venture capital method. Now, you need to understand that even if the company has a lot of potential, VCs might not come into it. Why? Because they need really big exits. So for them, they start on a reverse basis. Basically, they start with the end. They understand how much exit value, when they exit, what is going to be the valuation of the company. Then they understand what is going to be the terminal value of the company, right? And what kind of multiple are they going to get at the exit. A multiple is basically a percentage of your revenue or of your net profit. So when you would have heard words like 3x revenue or 10x of your profitability. That simply means that whatever is your revenue, 3 times of that is your valuation, or whatever is your net profit, 10x of that is your valuation. These multiples change based on industry and, again, business type, the environment that you're operating in. There's no fixed answer to this right now, but there is some kind of a multiple that these VCs estimate that they are going to get at a exit date. Based on that, they come up with a valuation. They come up with a post-money valuation, which is basically the exit value divided by the multiple. I'll explain this with an example. And then they come up with a pre-money valuation. Pre-money valuation is nothing but your post-money valuation minus the amount of money invested. Let's say, for example, a company invests 20 million at a 100 million valuation. That means that the post-money valuation is 100 million, and 100 minus 20, the amount that they invest, is 80 million, is the pre-money valuation. Then they account for dilution, that over the course of since the time that they invested till the time that they exit, there are going to be more investments coming into the company, and what amount of dilution would that mean for their stake if they do not invest more money into their company. So that gives them a final pre-money valuation at which they are willing to invest today. Now, no matter if your company's valuation does not meet these internal targets for them, they will not invest in you. This is not something that you should be looking at while creating your valuation, but this is something that you need to understand when you are pitching to investors, because if it does not fit into their valuation metrics, then they will not come in. Again, VCs do not usually come in at a very early stage, so this should not matter to you too much. But let's take an example. Let's say a company is going to sell when the VC exits. It's going to have a valuation of 1,000 crores. The multiple that they feel that they're going to get at an exit is going to be 100 crores. So the post-money valuation is going to be 100 crores. The round size, the amount of money that they are investing, is 20 crores. So the pre-money valuation is going to be 100 minus 20, which is 80 crores. Over the course, they're going to get about 40% dilution as the company grows. So the final pre-money valuation is 80 into 1 minus 40%, which gives them a pre-money valuation today of 48 crores. If your valuation today does not lie in that ballpark, they are not going to invest. Again, you can ignore this valuation multiple. This is from a VC's perspective, but you should be aware of it so that you are not naive enough that with a 5 CR valuation, you're going and pitching to them while they are looking to invest at a 50 crore valuation. And if you can't justify that 50 crore valuation today, then you're probably wasting a lot of your time in trying to pitch to them. Because no matter what you do, you are not reaching the benchmark that they have in order for them to be able to make money. Right? The next is a discounted cash flow. This is something that usually early stage startups are going to be building in terms of their financial model. Again, this is again a tough concept, so I'll try to break it down. Discounted cash flow, basically, if you go back to the drivers of the valuation that we spoke about earlier, the value of a company is the amount of money that is going to generate over its lifetime, and the amount of money, the value of 100 rupees today is not the same as the value of 100 rupees tomorrow. So whatever you generate in the future, you want to discount that. You come up with the discount rate, which is a combination of risk, of the cost of equity, and cost of debt. Right? With that, you come up with a discount rate on the basis of which you discount the future cash flow that the company is going to generate. So discounted cash flow method basically means that you've created a financial model. You've estimated that in year 1 you're going to make 1 CR, in year 2 you're going to make 5 CR, in year 3 you're going to make 10 CR, in year 4 you're going to make 50 CR, whatever that's going to be. And then you use this net present value formula. The net present value of your future cash flow, basically present value of that cash flow that you're going to generate in the future. You create a net present value that you add all of those and then you discount it. There's a simple formula which is sum of cash flow for every year, let's say t, divided by 1 minus r raised to the power t. This is a simple formula. In fact, there's an Excel function also that you can use, is equal to NPV, and then it'll give you the strings that you need to add into your Excel model, and that will directly give you this number. Again, this is a little tough for people who are not from a financial background to understand, but that's okay. The models that we have created as templates for you already have these formulas inputted. So all you need to do is input the basic basic figures into it, and it'll automatically fetch the valuation for you. Let's come to the comparables method. This is very simply put, you compare yourself to startups in the industry which are very similar to yours, and you value them based on a few indicators, such as they could be revenue-based indicators, such as your sales, your gross margin, your EBITDA, your profit after tax, or it could be based on users for people who are in this kind of a industry which depends more on recurring users. So daily active users, monthly active users, you benchmark yourself to a competitor, and then you compare your key performance indicators based on them or on theirs, and then you give yourself a valuation based on that. Again, you should be able to adjust this for the target audience. Let's say a company which is going after the US target market will have a lower valuation even with the similar products as compared to an India-based company, just because of the difference in the value of a US dollar versus the value of a Indian rupee, or let's say whatever market you're going after. So adjust your valuation based on the market that you're going after as well. Then there is the first Chicago method, where you do create a financial model, you do discounted cash flows, but not just for one model. You create 3 scenarios where you take the best case scenario, the more likely average case scenario, and then the worst case scenario. You assign different weightages to these scenarios. Let's say the best case scenario is going to have a 20% probability, the average case scenario will have a 50% probability, and the worst case scenario is going to have a 30% probability. You assign that, you come up with valuations for each of those criteria, then you multiply that to the probability that you assigned, you add them all up, and you'll come up with a weighted average valuation. The final way is, again, a football field method, where you take a lot of different methods and then you average them out. This will give you a better, usually average, that's the law of averages. When you take out averages on a lot of, in multiple times with a large data set, you usually come up with the right answer or very close to the right answer. That's the law of averages. So take multiple methods of valuation and then average them out. We spoke about top-down and bottom-up way of calculating your market size. Again, you could do the same thing while creating your financial model. You could use the top-down method where you start with the TAM, SAM, and SOM. Basically, you estimate the market sizes, the market that you're going after, and what percentage of market are you going to get. Once you have your market share, you can estimate the revenues that you're going to get in the market. Then you can also estimate the profitability of your company, ultimately coming up with the free cash flow. Again, if you see, everything over here is based on estimations. So how good or bad you are with assumptions and how much you can defend those assumptions majorly would be the point of discussion with your investors when you go after something like this. The other way, which is a more practical way, would be going bottom up, where you estimate the unit economics in terms of the users that you're going to have, how fast are those users going to grow, what are going to be the average revenue for each users, what are going to be your costs, then coming up with your profitability, creating your financial model basically from a bottom-up approach. I feel this is a better way to create financial model. In fact, the financial models that we are giving to you also are from a bottom-up approach where we try to estimate your growth, revenue, all those things before coming up with the final valuation numbers. So financial model, when you talk about financial model, it's going to have a couple of main things. One is your income statement, the other is your balance sheet. Your income statement or your profit and loss statement is going to have your revenues and your costs. A lot of these, again, are going to be estimated. So be mindful of that. When we talk about the revenue section, it's going to have your users, user growth numbers, the business model or the revenue model that you choose, average order value, lifetime value of your customers, whether your customers are coming to you once or they're coming back to you again and again for a recurring business, a recurring subscription, and then what is the churn rate, how many of them are staying, how many of them are going back. So all of those things need to be accounted for. In terms of cost, it's usually, when you're talking about a typical manufacturing business, it's usually the cost of raw material, of machinery, of setting up things. It could also be the cost of your talent. When you're talking about software businesses, it's the technology cost, the cost of buying software, building software. Then obviously there's the cost of distribution in terms of your marketing, sales expenses. There's your operational expenses, let's say the rent, the phone, the internet, water, electricity, things like that. And then you also have the cost of financing. Maybe you take a debt, you take a loan. What are the repayment options? All of those things add to your finance cost. To give you a very brief example of your income statement, this is how an income statement would look like. For, let's say, financial year 2024, you've been operating and you have numbers. For financial year 2025 and 26, the E in the bracket shows that you've estimated them. So first you have your revenues minus the cost of goods sold. This is a very basic financial model. You will, when you go through the financial model that we have, it's a lot deeper and you'll be able to see why, because there are multiple heads under that. But over here, I just want to give you a little brief so that for the people who are not from a finance background, they also understand what an income statement looks like. You have your revenue minus your costs of goods sold, which is basically your operation costs, your gross costs. That gives you a gross margin minus your expenses of your employees, your staff, your talent, less your expenses of your marketing or your tech, the finance costs. That gives you a basic net margin. You subtract the tax that you're going to be paying on that, and you come up with a profit after tax. In most scenarios, your profit after tax is also going to be your free cash flow, unless you are subtracting some kind of repayments to your investors, or if you have other investing costs, or you have some other reinvestments that you're going to be doing. So that gives you the free cash flow that you're going to have at the end of the period, which is ultimately going to determine your valuation. So I'm happy to share the financial models with you. You can find them with the links to in the description to this module, and you will be able to use them. Feel free, as I said, to share your financial models with us, and we'll be happy to give you feedback. We have a few different financial models based on the industry or the type of business that you're going to be operating in. So choose the one that works best for you. Again, if you don't want to directly do Excel, you can find the links to the websites that help you create financial models as well. Okay, now that you have created your financial model, there are a few important things that you should have usually at your fingertips, but if not, just keep these things in mind. Not just because your investors are going to ask you for those, but as business owners, there are probably thousands of other ratios that you can calculate, but these are few that you should have that will give you a pulse of your business at all points of time. So first, again, is your gross margin ratio, which is your gross margin divided by your total sales into 100. This will give you an estimate in terms of what is the incremental cost of selling your goods, right? Without increasing your operational expenses or any other expenses. If you had to sell more units of the same product, what would it cost? For a tech business, this is going to be much higher as compared to a manufacturing business, because once the product is ready for a tech business, it's usually marketing and sales costs. Whereas for a manufacturing business, for every additional unit that you need to sell, you need to create it. So your cost of goods sold is usually high. So the gross margin is lower as compared to a tech business. Then you have a net margin ratio, which is simply put your net margin divided by your sales into 100. Then you have your user acquisition cost. Again, something which is very important for you to understand. What does it take? How much money are you paying to acquire one new user? Your customer lifetime value, which is how much money is one user paying to you throughout the lifetime of that user with you. So if your users are working with you on a recurring basis, you estimate how long are they going to stay with you, and during that time, how much are they going to pay you? Or if you have, let's say, a D2C brand, you want to estimate how many times the user is going to keep coming back to you, what is the frequency of that sale, what is going to be the average order value, and on the basis of that, you estimate how much money a user is going to pay you over the course of their lifetime. For businesses that are technology businesses, software businesses, which have a recurring business model, basically any kind of business that has a recurring business model, you need to have a pulse of what is your monthly recurring revenue and what is your annual recurring revenue, and you want to showcase how much that is growing, what is the growth rate of your revenue. In majority of your cases, your valuation will also depend on this number a lot. You also want to understand your churn rate in terms of out of the customers that are coming to you, how many of them are going away from you. So let's say you can calculate your churn rate on a monthly basis, on a yearly basis, depends on the business that you're in, but you should know your churn rate as well. You would have heard the word EBITDA a lot. It's a very common word these days. It's nothing but your net profit before your interest, tax, dividend and amortization. Then you have your profit after tax, which is again profit after all these things are taken into account. These are all financial numbers. One ratio which I feel is very important at an early stage is net promoter score. This is not your financial ratio. It does not depend on your numbers, but more in terms of the user feedback. How likely is your user to recommend the product or service to his network, his friends, family, whatever, or people facing the similar problem. You ask your users on a continuous basis to rate your product or service on a scale of 1 to 10. That defines your net promoter score. Anything below 6, they're not going to promote you. 7 and 8 is okay. They are passive. They might or might not promote you. Anything above 9 is a great net promoter score to have, because these people are actively going to promote your product or service to people that they feel are facing the similar problems. Well, that's it. I know this was a little heavy in terms of the content, in terms of the module. I tried my best to simplify this for all the people who are even from a non-financial background. You can go deeper into this topic as much as you want, but this module should give you a basic understanding of what financial models look like and how you can create one for yourself. It is imperative that you have one, not just for your investors, but for yourself. Keep reviewing it. Do send them to us if you've created yours, and we'd be happy to share feedback. I look forward to seeing you in the next module.